We are just about 40 minutes, of course, into the closing bell. Want to get you up to speed with the day's options trading. Abigail, well, we're, again, sort of looking at equities to the downside ahead of that big CPI report.
Yeah, Taylor, and I would agree with you. It is a bit of a wobbly day, not a real clear signal on which way it would go. It seems as though investors are on pause ahead of that CPI report, clues as to what the Fed might do. Let's bring Alan Nuckman of Bullseye Option into the conversation. And Alan, you think that the Fed right now, because of course the CPI report is going to be one of the key data points ahead of the September meeting, you think that the Fed is, quote unquote, getting results. What do you mean by that, and what does it tell you about that September meeting?
Well, they've gotten exactly what they wanted, exactly what they were looking for. You've got commodity prices knocked down, crude oil's back down to 90 after being up to 120, 130. And more importantly is you've got longer term rates stabilized down here at 3-month lows. So that's the markets telling us that they're on the completely right track. If you look at the futures markets further out in 24, 25, 26, they actually have rates coming down. So it looks like they've managed this very well. But the last hurrah, obviously, it is snap-back attack in stocks. There's confidence again in that game.
So let's bring QT into the picture, because it's really interesting. You're bringing up this point that rates do seem to have stabilized, that 10-year yield closer to 280 as opposed to that 350 not so long ago. It would suggest that this would give them the room to really perform QT, and yet that's not really the case. What result does this have on volatility? In fact, is it subduing volatility as has happened in the past, I guess, on the other side of it with QE? Not that it's the same as QE, but when you have the expectation of real liquidity coming out and it's not, it could help.
Well, I'm not much of a why guy. I'm more of a how guy. How is the market going to move? And the market is telling me right now things are much more stable than they were a month ago, 2 months ago, 6 months ago. So I think they're definitely on the right track. The VIX is hanging around the 20 level. Stocks have surged 15% off their lows. So these are all very positive results. Corporate earnings came out at 6% when we were looking for 4%. That's earnings growth. Billions and billions and billions of pure net profit. So I don't think it's different this time. I think this was a pullback. I still think we need to get above 4,200 in the S&P to confirm that. Those were those June highs. But if that happens, that's the halfway point of the drop from the top. There's a lot more upside.
Interesting points, both on the VIX holding in there at 20 and the S&P 500 possibly going back to or above 4,200. China tech, though, which has been very strong on the year, really outperforming in a big way. More recently, it's been weak. You want to take advantage of that broadly and from a more micro standpoint through your trade.
Right. I've seen a lot of bounces from the bottom, and here's a stock that's trading sideways, had bullish divergence, meaning it made new lows but not new highs and implied volatility. That's usually when the shorts are set up for a squeeze, and that will rally that stock. It's traded between 18 and 22 for a month. A breakout of that range targets 26. We're about 19 right now. So I'm looking at the January $15 call, which is $4 in the money, deep in the money options, got a delta of about 80%. It's trading at about 550 or so. So the expiration break even's about $1 or so higher, with plenty of time. It's about risk reward. It's about this bullish divergence bottom. And let's remember that it's a $15 call. The low in the stock for the last 52 weeks and many years actually is 18. So it's a risk reward value play for somebody that hasn't participated in this bottom bounce so far.
Alan, somewhat quickly, let's bring the dollar into the conversation, because if it, of course, is off of the recent highs, but it's holding an uptrend, and that might really be the key tell as to whether or not risk assets can rally. If it drops, it would provide the fuel. But if it holds the 50-day moving average and climbs higher, it could present a little bit of a headwind. Are you taking a look at the dollar at all?
Yeah, the dollar is crucial, and that is the fact that it stopped rising. It had been rising and rising, and eventually it slowed down as they took all the rate hikes out of the future. So without more rate hikes, what's the fuel to drive that dollar higher? So if the dollar stops going higher or even declines, that's very, very much a positive, and that's what the markets are telling us with this dollar drop. Let's remember, over the last 20 years, I think you've seen the dollar between 80 and 120. So the 100 level is pretty much the midpoint. Yes, we've got a little bit above it, as markets often overdo, but I think that that rally run in the dollar has slowed dramatically.
A great point, connecting the dollar to the projection for rate hikes, or cuts next year. But how the market and traders are doing that, it's hard for me to know. Alan Nuckman of Bullseye Option, great to have you with us today for Options Insight. And from New York, this is Bloomberg.